Did you know that lump sum investments outperform SIPs nearly 70% of the time? This video reveals the surprising truth about when SIPs are truly the best choice, and how to maximize your returns in ELSS. Let's break down investing in a way that's easy to understand. There are a few main ways to invest, especially when you're looking to save tax with something called ELSS, or equity-linked savings scheme. First, what's a SIP? A SIP, or systematic investment plan, is like putting a little bit of money into something regularly. Like every month, think of it as a savings habit where you invest a fixed amount, say Rupee 5,000, each month in mutual funds. On the other hand, there's a lump sum investment. This is when you invest a big chunk of money all at once. So, instead of Rupee 5,000 every month, you put in Rupee 60,000 right away. ELSS is a special type of investment. It helps you save money on taxes. You can save up to Rupee 1,5 lakh each year and also has the potential for good returns over time because it invests in the stock market. The amount you invest has a lock-in period of 3 years. Now let's talk about the key differences between SIP and lump sum. With a SIP, you invest smaller amounts regularly. This helps spread out your risk because you're not putting all your eggs in one basket at one time. It also encourages a steady investment approach, which is great for building financial discipline. SIP is especially good for people with a regular salary. With a lump sum, you invest a large amount all at once. This can be riskier because the entire amount is exposed to market changes right away. But if you invest when the market is low, you could see bigger returns. Lump sum investments are good for people who have some surplus funds available. So how do you choose between SIP and lump sum? It depends on a few things. If you like to spread out your contributions and want to save regularly from your monthly income, SIP is the way to go. If you have a bonus or some extra cash and want to invest it all at once, lump sum might be better. Think about your risk tolerance too. SIPs are generally less risky because they average out the cost of your investment over time. Lump sum investments need a higher risk appetite because your entire investment is exposed to the ups and downs of the market right away. Market timing also plays a role. With a SIP, you don't have to worry too much about when to invest because you're investing regularly. Lump sum investments, on the other hand, can be more rewarding if you invest when the market is down, but that requires some ability to predict market trends. It's super important to match your investment style with your financial goals. If you're saving for something far off, like retirement or your child's education, SIP can be a good choice. If you just want to use the tax benefits of ELSS for a particular financial year, then a lump sum might be better. Now let's delve more into SIP. It works by averaging out your investment costs. When the market is down, you buy more units of a fund. When the market is up, you buy fewer units. This is called Rupee cost averaging. SIPs are also convenient because you can set them up to automatically debit money from your account each month. It's a flexible way to invest because you can choose how much you want to invest and how often. On the flip side, lump sum investing involves putting down a substantial amount of money all at once and offers more potential for high returns. If you invest a large amount when the market is at a low point, the gains can be impressive as the market rebounds. Also, lump sum investing is a one-time action. Then there's something called a modified SIP, which is a stable income plan. A modified SIP has a stabilization reserve which makes sure that retirees get stable income in the long run. These plans tend to be well funded. It's difficult to guarantee that SIP benefits do not decrease in retirement if the stabilization reserve is completely depleted. SIPs can also reduce their liabilities. Volatility reduction strategies is by adjusting the investment mix to be less volatile can create more stable VAP benefits. These plans are recommended for long-term investment tenures, and financial advisors can help evaluate whether SIPs align with one's financial objectives. Milliman Sustainable Income Plans, SIPs, is to build a reserve which is to build a stabilization reserve to shore up benefits following market downturns. SIP's strength is that a SIP provides all of the benefits of a basic VAP design. It provides well-funded plan and stability, but on the flip side, SIP can reduce benefits in rising markets because SIPs do not increase as fast in rising markets. And also its weakness is that a SIPs cannot guarantee benefits do not decrease in retirement. This is because retirees could still see their benefits decrease if the stabilization reserve is completely depleted. For NRIs or non-resident Indians, there are a few things to keep in mind when investing in the Indian stock market. NRIs can invest in equity shares, mutual funds, and ETFs. However, there are restrictions on trading in currency derivatives and commodities. Also, NRIs need to have an NRE bank account and a demat account. We've covered a lot in this video, but there are still some things we didn't get to. For example, the best way to rebalance your portfolio, or how different economic conditions might affect your investment choices. These are great topics to explore further on your own to build your financial knowledge and financial well-being. If you found this video helpful, please give it a like, share it with your friends, and subscribe to our channel for more amazing content on personal finance. Thanks for watching.